Carl, where is Deutsche Bank on this? Yeah, is our structural challenges, are they lessening at all?
I think that the structural challenges are lessening, and a lot of these factors, whether it's a low participation rate or duration of unemployment, all of these things tend to come out in the wash as the overall economic profile improves, the unemployment rate moves back closer to its natural level, which would be in the 5 to 6% type of range. So I try not to get overly concerned by some of these technical adjustments and rather focus on the pace of job gains, which, to be sure, based on the March data, the rate of hiring is certainly accelerating.
Michael, jump in here.
Yeah, there's some interesting things in this report that if we were going down in the economy, you'd see as worse. The number of people who are working part-time rose, but in this case, I'm guessing, Carl, it means that more people are coming into the labor force. Companies aren't quite ready to hire a full-time employee, but they're adding some part-time workers as opposed to people can't find jobs, so they're only taking part-time work.
Absolutely. We saw the beginnings of this trend really in October of last year as temp hiring really began to accelerate. And that was one of the first harbingers. You see temp hiring accelerate. Now you're seeing part-time workers improving as well. This all leads to permanent hiring in the long run.
And when do we start to see that flip over? You think it's about a month away here?
Well, we certainly are already seeing a significant acceleration in permanent hiring. So the trend is in place. We had a little bit of lumpiness in January and February due to the January snowstorms and whatnot. The March data, I really think this is evidence that the underlying trend has improved. This is going to be very important to household income generation, employment income, wage and salary income. Already in February, we saw that wage and salaries are growing 4% over year-ago levels. In the private sector, that number is 5%. That tells us that households will be able to tolerate modest increases in energy prices and inflation. Right. So the threat from gasoline is not significant, and consumer inflation is undoubtedly heading higher through year-end.
Carl, one of the themes on radio this morning was sector analysis of wages. Let's bring up this elegant chart, and this really struck me. Carl, it's normalized average hourly earnings. That's the white line, folks. In retail, average hourly earnings. Obviously, retail makes less, but there's different parts of the economy. Which part of our economy, our retail, technology, whatever, which part's going to lead the way here?
Well, already we're seeing that manufacturing employment is much stronger than what the trend had been leading up to the recession or over the past year. I suspect that in just the first couple months of this year, we're going to hire more workers in the manufacturing sector than we did in all of last year. And generally, in the early 2000s, that sector was losing jobs. That may seem insignificant, but actually manufacturing in terms of contribution to GDP is still very large, even though manufacturing employment as a share of total employment has fallen. That being said, there are a lot of tangential industries, service sector industries, that are very highly correlated with activity in the manufacturing sector. So this is certainly positive news. We see manufacturing overtime hours are at a very high level, and this tells us that in a lot of industries, not necessarily economy-wide, but in a lot of industries, they've stretched the existing workforce really as far as they can, and now the only way to meet increased demand is going to be by adding more workers.
Do they add more workers? They need more investment to do that. Are you going to see investment rise here through 2012?
Absolutely. That was largely the story in 2010. CapEx spending at a solid double-digit pace. I think that will continue this year because industrial capacity in the U.S. economy had fallen for the last couple of years. It's only stagnated now. Now, if the economy is entering a lengthy expansion and the industrial capacity is actually declining, that can't go on for too long. So businesses are going to have to ramp up their investment. And we're seeing the demand not only domestically from both households and businesses, we're seeing very strong export demand in the U.S. economy as well.
How many months of 200,000 plus do you need to see to call this a sustainable labor recovery?
I don't think I'll need to see too many more to be convinced. Certainly, it looks like this is the underlying trend. The fact that the unemployment rate is moving down at the same time that we're seeing these gains is really a positive sign. If we are getting private sector hiring in the 225 to 250,000 type of range, by the end of the year, I think we'll see the unemployment rate below 8%. We're targeting 7.8%.
That's a good number. Michael McKee, jump in again.
By the end, well, let's say by summer of next year, summer 2012, where do you think we'll be? Because that's what the president's going to be looking at.
Well, that's a very good point. By summer of next year, or as we go into the election of 2012, we are thinking that the unemployment rate will be closing in on 7%, or maybe even a little bit lower.
That's still the highest. That's still the highest since I think Ronald Reagan was president and running for re-election.
Well, that's high, but it's certainly moving in the right direction, and that's what voters are going to focus on.
When you look at this, you got to have wage growth to keep people happy. Bring up chart 3 here really quickly. This is debt service to disposable income. We showed this earlier in the week. What a remarkable success. Drew Mattis at UBS says debt lowered due to fear. People just got scared. Carl, we're in a much better shape to join 4 or 5% nominal GDP than we were 5 years ago, aren't we?
Absolutely. Debt service burdens have come down. And I know a lot of analysts, the more bearish-leaning analysts, are focusing on the lack of wage inflation. And that was continued to be apparent if we look at average hourly earnings in the March employment data. But the fact is, inflation is always a lagging indicator. In the broader economy, it's a lagging indicator. Just as we've now crossed well into expansion, finally we're seeing the turn in the CPI. The same thing is true if we look at subcomponents, like the labor market. The labor market's finally turned. The wage inflation will come. It's just not going to come right away, especially while there's still significant dislocation evidenced by the high unemployment rate.
Carl, wonderful. Thank you. With Deutsche Bank